Ted Steinkamp. I'm with Advanta IRA, and today we're going to be doing a brief webinar about how individuals that utilize their self-directed IRAs and taxable investors, how can they peacefully coexist inside of a real estate deal where a 1031 exchange may be involved. And today's guest speaker, I'll bring him on in a few moments. Very robust, very and extremely knowledgeable in this area. So without further ado, let's just kind of go through a few slides here, and then I'll bring on John Mangham in just a brief moment. But a couple of quick things here is, first of all, if my screen will advance, there we go. A little bit of brief background about me. I've been with Advanta IRA a little bit over a year. But actually have been in the financial services industry for 35 years. And if you've been on my webinars in the past, I've always said so much has changed over that 35 years, and one constant in this business is change. And there is much more coming. Keep your eyes open and always be learning, because what is coming in the future will definitely be a plate tectonic shift and a benefit to many of us. But of course, what is a financial services industry presentation without the obligatory and compulsory compliance disclaimer? So I'll give you the quick Reader's Digest version here. Just please keep in mind, Advanta IRA is doing this webinar for educational and informational purposes. We're not endorsing any particular investment provider or any of their advice or products. We just want to bring this for your edification. And of course, with any investment you make, always get the proper advisors involved when you're trying to make a decision. That includes your tax, legal, and financial advisors. And with that said, that's the end of the disclaimer. But let me just give you a quick and brief background about Advanta IRA if you're not familiar with us. We have been around for over 23 years. Very deep bench of talent here. We have people with CFPs, MBAs, people with legal backgrounds, and of course, most of our employees and team members here carry or possess the Certified IRA Services Professional designation. We're about a headcount of roughly 55 employees now. We continue to grow. And talking about growth, we have over 14,000 unique account owners. And at the end of last year, we tripped over the $3 billion asset mark for assets under administration. And all the way through the first half of the year, we've grown 20% in assets. So we're now at 3.6 billion. Very proud of that. 20% growth in 6 months for any business is not shabby. A lot of security here at Advanta IRA as it relates to the investments. Really, the only thing that's of direct monetary value in the accounts are cash balances, because the investment dollars that you deploy to the investment sponsor is over there. But what's left behind, we place that cash in FDIC insured institutions up to the applicable limits. And then everything here, we like to keep at a personal level with our clients. We maintain and provide concierge style service. And what that basically means is every account owner and client here at Advanta IRA has a dedicated account manager. So you are on a first name basis. You have a dedicated point of contact. You don't have to dial in on an 800 line and then go through the automated attendant, leave a message, hope someone calls you back in 3 to 5 days. We do have service standards, and we will get back to you within 24 hours or less. And of course, everything that we do here, we're all about transparency. Take a look at the AdvantaIRA.com website. We have a lot of our education tools up there, webinars, etc. I'll talk about that in just a few moments. One of the things I'm frequently asked is, what sort of accounts does Advanta IRA handle? Well, pretty much any account that has the letters IRA at the end, whether it's for individuals that want traditional Roths, inherited IRAs, rollover IRAs, we handle all of that. If you're a business owner and you have a business retirement plan, such as a SEP or a simple IRA, we do those as well as the solo 401ks. And a lot of people are not aware that you can also self-direct HSAs and ESAs, the healthcare savings accounts and education savings accounts. And we record keep and administer those as well. Moving on to the next slide, we're all about ease of doing business here at Advanta IRA. And basically what that means, we have completely automated about 90% of the account opening process. Takes about 15 minutes to open an account. You can either do it for our website or we can send you a link. Just complete the account opening paperwork that way. We'll send you whatever pages we need a physical wedding signature on. And then we will do the heavy lifting when it comes to transfers from other IRA custodians. We will initiate that process on your behalf. However, if you're doing a rollover from a previous employer's retirement plan, that is something you will need to initiate, but we'll certainly guide and coach you through the process. It's pretty simple and painless once you understand the basic elements of it, but it is something you do need to initiate. Advanta IRA cannot do that on your behalf, but we will do the coaching and help you through that process. And of course, when you find your investment, if you haven't before you open the account, all you got to do is reach out to your account manager, let them know, and they'll get that process started. As I said just a few moments ago, AdvantaIRA.com is our website. On there, you'll find our learning center that has all the events, such as the webinar series. We also do podcasts, and we have a couple of ongoing blogs. Feel free to go in there, check it out. And with that being said, and trying to keep on time, I want to introduce our guest speaker today, John Mangham. And very happy to have John today. And John, do you want to share a little bit of background about yourself?
Thank you, Ted, and thanks to the Advanta team for having me on the program today. Always appreciate the opportunity. As is shown here on my slide, I happen to be a CPA. I'm a real estate investor myself, and I want to give a shout out to the Advanta team. I'm also an Advanta account holder. So I'm a believer in using your IRA for investments, real estate investments, alternative investments. I walk the talk, I walk the walk as well as talking the talk. I've been in the 1031 business for 35 years, 35 plus, seen lots and lots of transactions, although I'm always open to a new twist. But I've seen a lot, and I've assisted a lot of investors in keeping lots and lots of tax dollars at work in the local economy and in your real estate, rather than sending it to Washington, D.C. So today we'll be talking about 1031 exchanges, the essential elements. We'll get into some of the interplay with 1031 and IRA, because an investor can't be over-equipped. Having lots of arrows in your quiver is a good thing, and just as an IRA is a very powerful arrow, the 1031 exchange is also.
Okay, John, let's make the switch over and let you go through your slide presentation.
Let's see. Thank you, Ted. Is my title slide up? Navigating Successful.
It is. I can see it. Yes, I can see it very clear.
Okay. So I know y'all got up this morning and said, boy, I can't wait to go to a tax program today at lunch. Instead of going out to lunch, I think I'll watch a tax program. And while Section 1031 is part of the tax code, and it is tax related, it's about saving capital gains taxes, I want to take us through 1031 with an eye towards how do you put it to work in your real estate investor portfolio? How do you make it work for you? So we're going to discuss the essential elements. We'll talk about what the tax savings can look like in a case study transaction. We'll talk about like kind, what is like and what is not like kind. I consider it to be your area of opportunity. We'll diagram a transaction from start to finish, the sequence of selling a property and acquiring a replacement for a successful exchange. We'll balance an exchange, make sure the dollars line up properly for optimum tax savings. And then we'll do a little bit of compare and contrast with IRAs, because as Ted's slide suggested, can IRAs and 1031 exchanges coexist? Well, the answer is yes. The answer is definitely yes. And as a real estate investor, again, I'll tell you, I think having both of those in your toolkit is a wise decision. So with no further ado, let me take you to the essential elements. I'm going to pop all four of these line items up here at the same time. And I like to break this down in a way that takes us to the simple, takes us to the easy to remember. And I give y'all my elevator speech. Many of you know what an elevator speech is. You get on the elevator and somebody speaks to you briefly and asks something about you, and you want to respond succinctly. You don't have a long elevator ride. Everybody's just trying to be pleasant. So picture this. I get on an elevator. I'm at a conference. I'm wearing a name tag and a ribbon because I'm a speaker. Somebody says, well, Mr. Mangham, I see 1031. What do you do? What's a 1031? And that's a common question when you say 1031 or 1031 exchange. What's that? So imagine that I get on the elevator on the second floor. We're going down to the first floor. I've got about 10 seconds to explain 1031 exchanges to a stranger in an elevator in a way that potentially leaves them with a message that they can use. So the underlined phrases on this slide are what's really important. I say to the gentleman who asks me, what's a 1031? Or what do you do? And I say, it's about tax savings. These are 4 two-word phrases. Number 1, tax savings. Number 2, investment property. In the world of 1031 exchanges, we work with rental houses, commercial property, raw land, anything that is not personal use, like your primary residence or a pure vacation home. So 1031, tax savings, investment property. There's a time period that governs a successful 1031 exchange, 45 and 180 days, and we'll diagram that time period when we diagram the transaction. Finally, if you're selling a property, the 1031 is based on the concept of a continuity of ownership. So if you sell a property for a certain price, you've got to acquire a replacement property for an equivalent or greater price. And we just break that down into saying equal or greater value. So step on the elevator, what's a 1031? Tax savings, investment property, time period, equal or greater. And I have folks who jot those down, and I'll tell you, let those be the building blocks of a successful 1031 exchange. Largely everything we talk about today will track back to one of these concepts. So when I say the essential elements, and when I want you to have in your head what a 1031 is all about, these are the 4 key items. Okay, with no further ado, let's take a look at what the tax savings look like. What's the tax calculation? And we're working with capital gains rates that were put in place in 2017. There are 2 components in real estate that we investors, y'all investors, are looking for. We're looking for appreciation. And if we're dealing with investment real estate that's improved, like a rental house, like a commercial building, we also want a depreciation deduction. And as time goes by, 2 things happen to your real estate. It grows in value, and that's largely true for most time periods, other than, of course, the downturn that hit us during 2008, 9, 10, 11, 12. That window was tough, but prices came back and went roaring past where they had sunk from originally, from the highs of 2005. They're even higher today. So I'm going to build an example to illustrate what the tax liability looks like. When we talk about tax savings, this is the question that you want your tax advisor or your CPA to respond to. If I'm selling a property, what do the taxes look like? So let me build an example. If you look here on the left, the words original basis. We bought a rental house years ago for $150,000. Today we're selling it. Up here at the top left, I've got a net selling price of $500,000. You have a gain in the transaction of $350,000. And some folks will say, wow, I've got a big gain. And I've heard that tax rates, capital gains, are 5% at the low end and 15%. And they start doing some math in their head and saying, wow, I might have $50,000 in taxes to pay. Well, there's more to it than that, because the other thing that happens to your property, if you look at the red wedge in the middle of the slide, the depreciation wedge, as time goes by, every year you take a depreciation deduction. You write off part of the cost of your rental house. And I'll use rental house because that's what this slide is framed up to represent. A rental house for $150,000 that we bought years ago, today we're selling for $500,000. Over the years, I'm saying we will have taken $50,000 worth of depreciation. When you go to sell that property, that depreciation has got to be recaptured. So if you look to the right side of the slide, there are two components that we're going to get taxed on: capital gain tax on the 350,000 and recapturing the depreciation deductions of 50,000. So let me flood the slide. I'm about to do what they tell us when we create a program: don't put too much information on a slide. So I'm about to overwhelm y'all. I'm going to flood the slide. Let's take a look at how this works. Again, we've got profit of 350, we've got depreciation of 50. So come with me across the bottom of the slide. The 350 of profit can get taxed at a maximum federal capital gains tax rate of 20%. That's $70,000. And somebody says, well, why am I not in the 5 or 15% bracket? Once you've made upwards of 325,000 in income, you bump into the 20% bracket. And this capital gain on this single transaction is enough to put you in that 20% bracket. Not to mention that you've got other earnings from your day job, your wages, your salary, wherever it may come from. So I use 20% because it's the maximum federal capital gains tax rate. Next, the next box towards the bottom, federal tax on the depreciation, there's a statutory recapture rate of 25%, and you pay that back on the 50,000 worth of deductions that you took over the years. So there's another 10,500. Finally, state tax. Georgia's state tax has dropped in recent years. It's down in the 5.4 range, and it's headed a little bit lower, but I use 6% because that's an average of state taxes across the country. Georgia used to be 6%. But when you take the 350 of profit or capital gain and the 50 of depreciation recapture, that 400 taxed at an average rate of 6% is 24,000. Add them all up, look to the lower right, and you find out that on the sale of your $500,000 rental house, you've got a potential combined federal and state capital gains tax liability of $104,000. So when I tell you this slide is overkill, this slide has a lot of information on it. This is the slide that I tell folks you should have your CPA or your tax preparer do a quick calculation, just a back of the napkin calculation. The house that you bought for 150, if I'm selling it for 500, what's my tax liability look like? And he's going to say, he or she will say, it looks like it's a little over $100,000. At which point you say, good gosh, I can't afford that. I might have refinanced this house a few years ago and pulled out cash. Gosh, what if you've got a mortgage of the house on 350 and you've got to pay 100,000 in capital gains tax? It's like you're not getting anything back. So it's important when you're analyzing the sale of investment real estate outside of your IRA, it's important to analyze what the tax looks like. Have your tax guy or gal do that calculation for you. This is the kind of calculation that I work through with people when I get a call about helping them with a 1031 exchange. And I'm not worried about down to the penny. The net selling price might be $498, it might be $505. All we need is a broad brush number. But we're using this $104,000 number as what are we looking at in terms of tax savings. So the essential elements of a 1031 exchange, number one, tax savings. A lot of investors take a look at that $500,000 sales price and they start thinking, boy, it's going to cost me a lot to sell the property. And the highest cost they typically attribute to the transaction many times is a real estate commission, whatever that number may be. But you don't know what the taxes are going to be until you have to pay them next April when you file your tax return. And if you go to the closing and sell this house for $500,000 and you don't know what your tax liability looks like, you're in for a big bad shock next April. This tax liability is potentially more than 3 times the cost of the sale of the transaction. So it's significant, and this is what makes 1031 exchanges such a powerful tool for real estate investors. So let me move forward. Let's talk about how we do what we do. This is right out of the tax code. And this is I call it the dry and boring slide. No gain or loss shall be recognized on the exchange of property held for productive use, blah, 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 blah. See, it already starts to run together. I've highlighted the important words. Property held for investment, there it is in red, exchanged for property of a like kind to be held for investment. And what that means is the IRS does not dictate that if you're selling a rental house, you have to buy a rental house. The IRS does not dictate if you sell raw land, you have to buy raw land. The IRS says, as long as in the hands of the taxpayer, the property is being held for investment. It can be exchanged for any other property to be held for investment. This is your area of opportunity. When we talk about the essential elements, number one is tax savings, $104,000. Number two is like kind. And let's take a look at some things that are like kind. Here we go. This slide is intended to demonstrate that a rental house is like raw land, is like an office building, is like apartments, is like hotel, motel, strip shopping center, self-storage facility, senior housing. Any real estate is considered like kind to any other real estate. So if you're an investor who's done well over your investing career, you've got some assets inside your IRA. When they sell, the money goes back into the IRA, no problem. You've got some assets outside of the IRA. When they sell, you use 1031 exchange as the tool. And let's say you've accumulated an inventory or a portfolio of rental houses. You sell 2 or 3 rental houses and you're tired of tenants, toilets, and termites. You're ready to move on down the road and put your money into a commercial property, a strip shopping center, an apartment property, I would say office building. And of course, we've used office on this slide for years. Right now, office buildings are out of favor because during COVID, everybody left the offices, went to work from home. The value of office properties dropped. But from a conceptual standpoint, you could sell a rental house or rental houses and acquire commercial property. You could sell raw land. If you've got land that's been in your family for years, if y'all inherited land 20 years ago and today it's worth a lot of money, the developer wants to buy it and develop it and build houses, you could sell that land and buy rental houses. You could sell that land and buy apartments. So the message here is that it's all alike as long as it's property held for investment. Now, the last upper right picture, tenant in common, fractional interest. Imagine a scenario where several of us own a piece of property together. Let's say I put Ted in a deal with me and 2 other people. So there are 4 of us in the deal. We all own a fractional interest held as tenants in common, sometimes called co-tenancy. 5 years ago, we bought this strip shopping center for $1 million, 4 of us. We put in $250,000 apiece. Today, we're going to sell this strip shopping center for $2 million. Can you imagine that after 5 years, one of the partners, oh, there's that word, partner. We tend to call ourselves partners. We're partnered up with each other. In the tenant in common ownership, it's not partnership ownership. It's not a legal partnership or an LLC. It's co-ownership where all 4 individuals are named on the deed. Each one of those individuals can choose whether to sell their share or whether to cash out and take the money. And what if Ted owns a quarter and John owns a quarter and Linda owns a quarter and the 4th fractional interest is owned by somebody who holds their interest in an IRA? Then the 4th fractional interest is going to be Advanta as custodian for the Bill Smith individual retirement account. That can happen. Back to, can transactions coexist? And the answer is yes. You can have different kinds of owners and they can be co-tenants. So back to my example on the retail building in the upper right. We bought it for $1 million, we're selling it for $2 million. Those are fractional interests, but a fractional interest is considered like kind to a full fee simple interest. So I could sell my fractional interest for $500,000, 1/4 of $2 million, and I could acquire a replacement property. Maybe I want to go buy rental houses. Maybe I want to buy a property in a nice location with sand in the front yard and waves crashing just beyond. Can I sell a fractional interest in a commercial property and buy a condo at the beach, put it in the rental program, rent it out? And the answer, of course, is yes, you can do that. So like kind is your area of opportunity. When we're talking about essential elements, number 1, tax savings. Number 2, like kind. And I talk about like kind in the life cycle of a real estate investor. A lot of us start out by buying a rental house. And if that doesn't kill us, obviously it makes us stronger. And as time goes by, we have a number of rental houses. But as we go through our investing career, at some point we've got IRA funds, we make investments through the IRA. And at some point we say, I don't want rental houses anymore. I want to look to a different kind of investment, something that requires less management. And so the shift in what you own today from what you owned 10 and 20 years ago happens as you move through your career. And as your assets grow, when it comes time to sell them, you don't just sell them and cash out. You don't just sell them and take the money and go down the road because you're going to take a big hit on taxes. You consider a 1031 exchange, and you look at what's going to serve you for the next 3 to 5 to 10 year window. Or depending on where you are, if you're really far along in your investing career, you start looking at what the next generation might need or want to do if they're going to inherit some of your assets. So like kind and tax savings, the two first essential elements of a 1031 exchange, are not just part of a transaction. They're not just part of a 1031 exchange where you sell a property and buy a replacement. They're part of your investment philosophy as you go through your investing career. And they're part of building wealth for you and for your family, not only for yourself while you're alive, but potentially multi-generational. So I've worked with 1031 exchange clients for 35 years. There are still people who are coming back to me from transactions that I did all the way back in the late 1980s. And so I've had a lot of great stories. It's enriched my investing career, and I try to share the essence of the stories when people call me and or when we're doing a program like this. So let me move forward. Ted, I think we're rolling along fine. We've got two of our essential elements squared away: tax savings, investment property, or like kind.
Yes,
Next
we
up,
are. We're moving.
so far so good. And it looks like we've added a couple of attendees. Excellent. All right, the next thing I'm going to do with this framework in mind, we're going to go through the exchange sequence. In this diagram up at the top, I've got the exchanger, Mr. Smith. He's going to sell this rental property, property A. Over there on the far left, we've got Mr. Jones, who's going to buy the house. Jones can be a first-time home buyer. Jones is going to move in and live in the house happily ever after. The end. Doesn't matter who the buyer is. Jones could be a hedge fund. Jones could be anybody. It makes no difference. Smith is going to be the exchange client, and Smith is the client who's going to be doing the exchange, selling the property. So let's write a contract between the parties. Right here, we're writing a contract. In the stipulations, we make a reference that it's part of a 1031 exchange. Just like your standard real estate contracts today, the only small extra item is a stipulation that says it's the seller's intent to perform a 1031 exchange. Now, to close this transaction, and I'll use today as the day of closing, October 9th. If we're closing the transaction today and Smith goes to the closing and takes the check, boom, that's a taxable event. So we've got to structure this where there becomes an exchange of property for property. To do this, we're going to assign the contract right here in the middle. I'm assigning the contract from Smith to a third-party facilitator known as a qualified intermediary. Craft 1031, my company, provides those services. So Craft 1031 is going to take assignment of the contract, sell the property to Jones over on the left in exchange for the money. The funds in this transaction go into a 1031 exchange escrow account to be held for the benefit of Smith to be used to purchase replacement property. But the left side of the slide, which I can refer to as phase one, is when Smith relinquishes a property. He's not touching the cash. He doesn't have a taxable event, but the clock starts running today, October 9th, when the property is sold. So let's transfer the deed, go to closing, and add a timeline across the bottom. So what I've done from here to the next slide is the clock starts running. From the day of closing, Smith has 45 days to identify replacement property. And folks, if there's one soapbox that I will jump up on, and I don't yell at the top of my lungs, but the most important thing in a 1031 exchange for the client to keep in mind is that 45 days goes by so blazing fast, you've got to be shopping for replacement property. Now, over here on the right, you can see we've got Miss Brown. We're going to go purchase the house that she's got. It's up here at the top of the slide, house B. Smith is going to be buying B. And what happens is Smith should be shopping for the replacement property before October 9th. In fact, if Smith is prudent, Smith is shopping for property B back in September, back in August maybe, perusing the market, looking at what opportunities might be out there. Folks, you can even be under contract to buy property B. Let's write that contract. you can be under contract to buy property B from Miss Brown in advance of closing the sale of property A. And where that leads us is to a well-executed exchange where when property A sells, a few weeks later, you close on the acquisition of property B. Now, you probably can start to see where this is headed. We're relinquishing property A, we're going to get back property B. But let's talk about how this transaction unfolds. Remember on the left, phase one, the intermediary took the proceeds, put them in the exchange escrow account, and the clock started. On the right side of the diagram, we've got the contract to acquire property B, and the intermediary is going to deliver the proceeds right here across the bottom to the closing of property B by, I'm putting the word by in air quotes. The QI, the qualified intermediary, buys property B and transfers it back to Smith. So the deed goes directly from Brown to Smith. The IRS regulations provide for a direct deeding sequence. When you look at this picture in toto, if you look at the whole thing, look at the center where you see the swap of property A for property B. One of the critical IRS requirements for a 1031 exchange is that there's got to be the reciprocal transfer of property. And the representation in the middle of the slide here is that the intermediary is receiving property A and is giving back property B. The intermediary was able to perform those functions because he stepped into the shoes of Smith and transferred the sale of property A and acquired the replacement of property B. So the essence of the 1031 is that you have a delay between the sale and the ultimate purchase. And in that delay, the intermediary is working with Smith along the way. So this is the exchange. This is the exchange sequence where we say Smith sold to Jones, but Smith actually assigned the contract to the QI who sold to Jones, held the funds, delivered the funds to Brown, received assignment of the property or of the contract, and transferred it back to Smith. So at this point, we've got three of our essential elements: tax savings, investment property. Number three, time period. The critical time period of 45 and 180 days in your 1031 exchange, 45 is the tough one. 180 days, most people don't have a problem getting the replacement property purchased within 180 days. And that's usually because the relinquished property that they have got it under contract during the first few weeks, and they close on it 4 to 5 to 6 weeks later. The average time period for a 1031 exchange, the folks in my business, the folks in my industry who track statistics occasionally, say that 1031 exchanges have an average life cycle of 50 to 55 days. And depending on when they compare the numbers, you'll hear 40 to 50 or 40 to 60 days. The reason the life cycle is so short is because a well-executed exchange is when you've got property B under contract before you sell property A. And then you just go about the process of selling property A, and then you forward the funds and you close property B. So tax savings, $104,000. Investment property, it's all alike as long as it's held for investment. Number three, time period, 45 and 180 days. Okay, let's move forward. For all of y'all who have solved all the world's problems on the back of a napkin, and then of course the next day you don't know where the napkin went, here's the napkin test that we use to balance a 1031 exchange. On the left side, we've got the sale property. We're selling for $500,000. Remember, we bought that property for $150,000. At the closing, let's say the mortgage balance was $100,000. So the equity that came out of the transaction was $400,000. What you got here is $400 in the exchange escrow account, a tax liability of $104,000, and Miss Brown's replacement property is being acquired over here on the right for $600,000. The $400,000 moves forward. If you think back to the previous slide, going across the bottom, the cash came from the cash came from Jones, who bought property A, went into the exchange escrow account, $400, and then it transferred over to Brown, the additional $400, or the 1031 funds of $400. The additional $200 came from getting a new mortgage on the replacement property. And y'all, if you don't think that getting $200,000 is easy on a $600,000 acquisition, I'll tell you all day long, lenders are lining up to lend on that replacement property because you've got $400,000 in equity You're increasing your overall asset base from 500 to 600. The cash is being spent forward. And as long as it's equal or greater, it's totally tax deferred. Check the fine print. In the parentheses, I've said spend the cash. The cash from the relinquished property must go into the replacement property or properties. And while I don't have a multiple property math example to give y'all today, if you think back to our like-kind slide where we talked about a fractional interest, where we sold a house and we bought a fractional interest in a commercial property, a fractional interest is a quantity other than one. You could also have a fraction, or you could also have a quantity that's greater than one. For example, on this slide, my $600,000 replacement property could be a pair of $300,000 rental houses. I could sell a $500,000 rental house that maybe I'm only able to rent for $2,500, $2,800 and buy a pair of $300,000 rental houses that I might be able to rent for $2,000, $2,200 a piece. So I've taken my gross rental income number from $2,600, $2,800 up to $4,400. It's a technique that the 1031 exchange is here to facilitate. As you grow your portfolio, as you grow your cash flow, you've got to always be looking at your portfolio. And 1031 is going to be there to help you save that $100,000 instead of sending it to Washington. Okay, when we look at the napkin test, when we look at balancing an exchange, the very basic strategy that I always like to address and suggest to people: what if I buy a property for a lower price? And back to my equal or greater statement. Remember, we're selling a property for 500. Don't fall into the trap of asking your agent to show you everything in a certain zip code for 500 or greater, because you know equal or greater is the requirement for a 1031 exchange. What if you find a replacement property for 475? Well, if you only look for listings in a certain zip code for 500 or greater, you won't catch that property that came on the market last night for 475. What if that property is a killer deal? If it's a killer deal, then for gosh sakes, buy the property, put $375,000 cash into it, get a mortgage. Whoops, my mortgage balance is off. That mortgage needs to be $100,000. Ted, my apologies. It's amazing the things you see when you're in the middle of the presentation.
No problem.
So on the right side where the mortgage is 200, that needs to be 100. My point here is, and let's bring this up, there's boot that comes out. Follow the cash line item across the bottom. When the cash from the relinquished property is 400, you put 375 in the replacement and you take 25,000, put it in your pocket. What happens in this transaction is, we would call it a partial exchange. You pay a little bit of tax on 25,000. And if you do the tax calculation and you find out that you've got to pay $6,000 or $7,000, but you're saving, you previously were saving 104,000, you pay 6 or 7, you're still $97,000 to the good. So from a practical standpoint, while the rule in 1031 is equal or greater, it's equal or greater to be totally tax deferred. The rule for investors to remember should be, the strategy you want to use is find the best deal. And if that means the deal is a little less expensive than the one you sold, do the best deal that fits your portfolio. Calculate what your return's going to be, look at what your cash flow is going to be, do the best deal that's going to work for your portfolio and your long-term growth strategy. So this is a basic strategy when you're hunting. Hunt for something, start your threshold a little below, maybe 10% below, you pick the number. But the idea is look for replacement property a little bit below the relinquished property, just in case you stumble on a killer deal. Okay, tax savings, investment property, time period, equal or greater. We've gone through the 4 essential elements. We did a little case study to show you what the tax liability looks like. We walked through the logistics, the step-by-step in diagramming the transaction and illustrating the 45-day. 45 days is a hard and fast rule. I'll say it again. Shop early, shop often. Don't let that 45 days get ahead of you. And then finally, equal or greater value. Okay, so those are the 4 essential elements. And I know we're going to be taking some questions, but I want to go to a slide because we talked about comparing and contrasting 1031s versus IRA. And with IRA, I always point out Roth IRA. And that just deals with the taxability of whether you've paid the tax before the money went into the Roth, or whether you're going to pay the tax when the money comes out in the conventional IRA. So key points to have in mind in the world of 1031 and IRA investing. Both vehicles are viable for investors. You should have both vehicles, or as I call it, both arrows in your quiver. There's a time to use one, there's a time to use another. Inside the IRA and outside the IRA in the world of 1031, both create tax deferral. Now, inside the IRA, if you have a conventional IRA, you put the money in and you haven't paid taxes on that money or the growth of that money, you won't pay tax till you start taking withdrawals. But at some point, taxes do get paid. In the Roth IRA, you pay taxes before you put the money into the IRA. With a 1031 exchange, you've got the opportunity to create tax deferral as long as you own the real estate. So if you sell the rental house A and acquire property B, and later you sell property B and you purchase properties C and D, you can keep rolling forward with the 1031 exchange. The taxes will continue to be deferred as long as you own the real estate. And the big kicker with 1031 exchange, when we talk about a multi-generational estate planning and wealth building strategy, a 1031 exchange, if you pass away with your highly appreciated low basis assets and leave them to the next generation, your heirs will inherit those rental houses. They could sell them the next day and they would pay no capital gains tax. So the outside tax savings, the use of the 1031 exchange, can create permanent tax deferral, albeit it doesn't become permanent till you die. And of course, that's a pretty permanent position. But the point here is both of these vehicles provide for tax savings, both of which boost the value of your investing portfolio. Okay, next line item, personal use. IRAs, if you own real estate in your IRA and you use it personally, if you use a beach property that's in your IRA, if somebody looks at that closely, that could be attributed to be a distribution because you got a personal benefit from the real estate inside your IRA. You can't do that. In a 1031 exchange, if you've got a vacation home that's part of a 1031 exchange, you've got a limited ability to use that vacation home personally. The IRS has some vacation home rules that basically say you can use that vacation home 14 days a year for each of the 2 one-year periods following the acquisition, following the exchange. So there's some differences in the personal use aspects of the 1031 arena versus the IRA arena. Finally, when we look at comparing and contrasting distribution/conversion, in a 1031 exchange, you have the opportunity at some point in the future, if you exchanged into a nice house in a pretty location and you want to retire into that property, you can convert that house to your personal use, primary residence, or pure second home. You don't have taxability upon the conversion. You would only have taxability if that house were to be sold. And again, if you don't sell and you pass away owning that property, it goes to your next generation, they get a step up in basis. With the IRA, if there's a distribution and or a conversion to personal use, you're either going to be subject to withdrawal limitations or you're going to be subject to IRA taxability guidelines. If it was not a Roth IRA, when a distribution takes place, you obviously have a taxability issue to think about. So there are differences between IRAs and 1031 exchanges. They're not exactly two sides of the same coin. However, they are both coins that investors need to have. They're both tools you need to use. I'm an advocate for both, and I'll say again, I'm an IRA account holder with Advanta. So I use my IRA and I invest with my IRA because I believe in what I do as a real estate investor. Okay, let's see what we've accomplished. I'm going to pop all these up at the same time. I don't need to read everything to you. Folks, with a 1031 exchange, whether you're acquiring larger or more property or more properties, whether you're consolidating, selling 2 or 3 rental houses to buy a larger one, whether you want to diversify a large piece of land and acquire a bunch of rental houses, or convert rental houses to commercial property, relocate if you've moved to Atlanta and you used to live somewhere else in the country, you want your assets close to where you can operate them. 1031 exchange will help you get there and will help you in a very substantial way when you look at the tax savings. Finally, retirement planning. It's one of the favorite topics people like to ask me about. Can I do a 1031 exchange, buy the condo at the beach, and one day retire to the beach? The answer is yes. There's a process you can go through. So if you can accomplish your goals and defer taxes, both inside and outside the taxable and non-taxable vehicles, you're going to be a stronger investor. Whew, Ted, I think we just burned through 50 minutes of tax talk.
You did, actually.
Or darn close to it. I hope everybody's got
the audience intact.
Well, I hope everybody's gotten a good framework of 1031 exchange. Again, the essential elements: tax savings, 104,000, like kind or investment property. Number 3, time period, 45 days is critical, and finally, equal or greater value. Along the way, I tried to share a few strategies that I see people use, and I'll be glad to talk with anybody about their potential 1031 exchange. You don't use 1031 inside your IRA. You don't need to. Your IRA is already tax deferred. You use 1031 outside your IRA, but they go hand in hand. Ted, thank you again for the opportunity to let me talk about taxes and 1031 exchanges today. I think we want to take a few questions. I'll let you take back over. Thank you.
Yeah, absolutely. And I appreciate you sharing all this, John, because one of the things we cannot do here at Advanta IRA, as I mentioned earlier, we can't provide tax advice or really talk much about the tax code unless it's something that's just very black and white related to our business. So this covers an awful lot. I do have one question. This is a personal question because I've seen this out in the marketplace with investors. Quite frequently, you'll have a situation where, or I've seen it, where it'll be a group of investors, could be 4 or 5. They're going to participate in the investment of a property, and maybe 1 or 2 will be self-directed IRA investors. The others will be taxable investors. And obviously, everyone wants to maximize what they're going to receive. But at the time of disposition, what's going to be the best strategy to satiate the needs of both parties when it comes time to dispose of the asset?
So Ted, that's a good question. And again, to frame up the network, we'll say there are 5 investors, 3 regular investors, and 2 IRA investors. Whether they own it in a partnership or an LLC or as tenants in common. If they own it as tenants in common, and let's say they bought a $500,000 property, each put up 100, and later they're going to sell it for $1 million, so each would get 200, just to use an easy example. If they own it as tenants in common, then there will be 5 sellers, 5 people on the settlement statement, and 5 line items and 5 checks. The 3 individuals can do 1031 exchanges. The 2 IRA sellers are actually going to be signed off by the IRA custodian. Your folks at Advanta will have to participate in that transaction for those 2 property owners. Now, if they're inside an entity like an LLC or a partnership, the entity can sell the property. And it gets a little tricky here. The entity could do a 1031 exchange because the entity has that capability. All 5 people who are in the entity stay inside the entity, and then that $1 million sale, somebody, that you go and buy a replacement property. If, however, the 5 partners that are inside the LLC, some of them want to go a different direction, want to do a 1031 exchange, or the IRA partners want to just put the cash back into their IRA accounts, you can distribute the asset from the entity in a non-taxable distribution. Partnership tax law provides for non-taxable contributions and non-taxable distributions. So if we own the 5 shares inside an LLC, prior to closing, we would have typically the closing attorney prepare a deed to transfer from the LLC to the 5 individual members or owners, 3 individual outside of IRA and 2 IRA custodians for the benefit of each individual IRA account holder. We would distribute to 5 co-tenant shares of the property as tenants in common. And then you're back to the same scenario we went through on the first one. All 5 owners get shown on the settlement statement. The 3 outside investors could do a 1031 exchange. The 2 IRA investors would have the cash go back into their IRA accounts. They don't need to do a 1031 exchange because they're already inside a tax deferred vehicle.
Okay. But because of the existence of the 3 taxable investors, would that 1031 total be, the amount be changed from $1 million to a lesser amount?
If the partnership did a 1031 at the partnership level, then the partnership would be doing the 1031 exchange at the full $1 million level.
Okay.
If the 2 IRA individuals did not want to participate going forward, you could drop the 2 IRA shares out and the partnership would have the remaining 60%, in which case the partnership would do an exchange on 600,000. If you dropped all 5 shares out, then each of the 3 individuals could do 1031s, and the 2 IRA members would have 200,000 go back into their IRA. Their original basis of 100 would have grown to 200. So their IRA grew from 100 to 200 for this particular asset.
Which is beneficial for all.
Absolutely. Everybody wins. What's important, and y'all know this, and I tell people all the time, it's important to be talking to your custodian in advance because it takes a little extra time to bring another party into the process. It's important to talk to your CPA in advance, and it's important to talk to your 1031 folks in advance.
How much lead time though? Would you want to do it like 6 months prior to disposition?
We could have the asset dropped out of the entity during the week or 2 prior to closing. I would want to be talking to this group of partners probably a month before so that they're planning properly. And if they're doing a 1031, the most important thing is shopping for replacement property. Light a fire under them, have them go look for whatever they think is going to be a suitable replacement. The longer lead time, because you've got the extra signature process with the IRA custodians, I would suggest that talking to people a month in advance gives the IRA custodian, gives Advanta plenty of time to coordinate signatures, gives your 1031 company plenty of time to get the 1031 process started. So in terms of lead time, a month is a good number. We could do this with a couple of weeks notice, but don't call us the day before closing and say, can I drop this asset out? I'm closing tomorrow. And y'all's turnaround time is potentially 24 hours. But if you don't call the client back and the closing's already taken place, it's too late. So preparation is key. Give us a few weeks and we can, both the Advanta team and your 1031 team can help make your transaction work smoothly.
Okay, very good. And I do have a question from one of the attendees. And the question on this one, John, is there a fund you can move gains into that would give you longer than 180 days and pay a fee or penalty if you can't identify a property in time?
So in the world of 1031 exchanges, the 45 and 180 day timelines are absolute. The only time those dates get extended is when there's a natural disaster, like if a hurricane sweeps across Florida or when the tornadoes came through South Georgia. It requires a presidentially declared disaster. Presidentially declared, not just a catastrophe where your trees got knocked down. And what happens is the president will tell the Treasury Department, the IRS, to provide an extension for timed events, like the filing of quarterly estimated tax payments, like the filing of your tax return on April 15th. And they will give an extension to affected taxpayers, which will be taxpayers who live in the counties or the properties located in the counties where the catastrophe struck. So the California wildfires hit that section of California. That county got an IRS extension, and that got people an extension if they were doing a 1031 exchange. They got more than 45 days and they got more than 180 days. But folks, don't ever go into a transaction hoping for that kind of catastrophe. You don't want your relinquished property or your replacement property to get beat up by a hurricane. You've got much bigger problems. What you really want to do is shop in advance and be ready to buy your replacement. Most exchanges get completed, in under 60 days. The IRS would rather you trip. The IRS would rather you pay the taxes. And so my big job in life is to make sure you understand there are no exceptions, there are no ifs, ands, or buts. This is an extremely powerful tool. Please go shopping in advance and go find that absolute great opportunity.
Good deal. And just had one more question slide in, and we're coming up at the top of the hour and on time. One of the attendees has stated they bought a rental 13 months ago for $200,000 and used $100 from their Advanta IRA and $100,000 cash from their bank account. How did they handle the sale of $300,000 because they're listing the property next week?
Well, one question that I won't go deep into, it may have been structured where they made a loan, or it may have been structured where 50% of the property is owned by the IRA custodian and 50% of the property is owned by the individual. When you go to sell the property, you have co-sellers, if you will. And so the individual can do a 1031 exchange on half the property, the 150,000, half of the 300. The other half of the property, which was provided for by the IRA funds, the 100,000 there, 150 should go back into the IRA. The question would be, what's the tax liability on that $50,000 gain on the individual side? And if you apply, you may not have to go to the 20% level, but if you use 15% federal and 5% state, 20% tax on the 50,000 is $20,000. So you potentially are going to pay tax on half of the property because it was outside of the IRA. The $50,000 gain inside of the IRA goes back into the IRA custodian's account. I would treat it as a co-ownership situation.
Okay. And then one more question has just slid in. And what's being asked, John, is would utilizing the 1031 exchange with a sub S corporation be the same as with an LLC?
So any individual or entity that owns property with a gain can do a 1031 exchange. Individual, partnership, LLC, corporation, sub S corporation, trust, estate, anyone can do a 1031 exchange. A sub S corporation is compared to a partnership or an LLC frequently because you don't pay income tax at the corporate level. The sub S corporation gives the shareholders a K1 and they get their share of the operations of the sub S corp. So if you own an asset in a sub S corp, you can do a 1031 exchange. You've got to buy the replacement property inside the sub S corporation. What's difficult about a sub S corp versus a partnership or LLC? LLCs work under partnership tax law, where you can have non-taxable contributions and non-taxable distributions. S corporations provide for passing the benefits to the shareholders. But if you ever take an asset out of an S corporation, if you should ever want to transfer a rental property that you exchanged into a beach property that you want to move into one day, if you ever take it out of that S corporation and put it in your name individually, that is a taxable transfer. So owning real estate inside an S corporation is generally not advised for pure real estate investors. It's fine if you're an operating company. It's fine. IBM owns its real estate inside a corporation. Delta owns its real estate inside a corporation. But if you're going to be a steady Eddie real estate investor, you generally are going to want to own your assets inside LLCs, or in the old days, we would have said partnerships, because you've got greater flexibility, particularly in the aspect of being able to transfer in and out of that entity. So in summary, an S corporation can do a 1031 exchange, but an S corp cannot make a distribution to the shareholder that is non-taxable.
Okay. And the good thing is they liked your answer because I got a quick reply in capital letters. Awesome. Great news. So
good.
So thank you.
Of course, you know, I say it goes without saying, but I guess I'm about to say it. We handle 1031 exchanges for all kinds of entities. We've been doing this literally across the country. It's federal tax law. We're set up to do this in all 50 states. And I've been doing exchanges since 1988. So Ted, if any of your attendees, if any of your account holders have 1031 needs, we're here to help them and would be glad to take the call. We operate on the basis of a no obligation phone consultation. Feel free to call me and I'll be glad to talk through the questions. If you take me down the path of IRAs, I can answer the first layer of questions, and then I'm going to refer you to Ted and the good folks at Advanta.
Great, thanks, John. And John, many thanks for doing the agreeing to do the webinar today. Awesome job, lots of information, and just looking at the few questions we did have come in, clearly people understood the content, because I know this is sometimes difficult to explain, and then the questions were all on target, which is awesome to see. So,
excellent.
Well, great. Well, I'll tell you what, we are on top of the hour, and we're going to have to draw things to a close. What I would like to do for anyone and everyone that is interested in reaching out to John, of course, his slide and his contact information is up on the screen. We're going to be posting this webinar recording on the AdvantaIRA.com website, also on our YouTube channel. You can just put in the search box Advanta IRA, and should be about 24 hours it will be posted. And if you do have any questions and need to reach out to me for a copy of the slides, feel free. My contact information is up on the screen. And with that being said, how about we draw this to a close? And I wish everyone a very productive day. And John, again, thank you very much for being today's guest speaker.
Thank you, Ted. I appreciate the opportunity.
Hey, good deal. Well, everyone, I wish everyone the best. Have a happy, productive day, and look forward to hearing from you and seeing you on the next webinar. So with that being said, drawing it to a close. Wish everyone the best. Thank you.